Hello and welcome to this programme from Baillie, Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment funds. Today we're talking to Stephen Hay, and Stephen is co-manager of the Baillie Gifford Managed Fund. My name's Richard Lander of Citywire, and we're going to be talking for about 20-25 minutes about how he runs the funds. And along the way we'll try to answer three questions: why active, why growth, why now? So Stephen, welcome. And very nice to see you.
First of all, Richard, I think we'll get to why active, why growth, why now. But I think first of all, maybe just why invest in a managed fund, full stop. So for me, it makes life simple for the client. We've only got three asset classes. We've got equities, bonds, and cash. And really, it is a one-stop shop for access to the best of Baillie Gifford stock picking and bond picking, with one of Baillie Gifford's longest standing funds, been going for over 37 years now. And my co-manager, Ian McCombie, and I have been working together for over 20 years now. And we've got a very clear philosophy and process for finding the best growth companies. And that's been consistent right since the launch of the fund. And we balance that with an active bond portfolio and a small allocation to cash. So we do the asset allocation for you. We've got deep bottom-up knowledge of every stock and bond in the portfolio. So making judgments about trade-offs between different holdings rather than like generic top-down equity views. And lastly, as well as keeping it simple for the investor, the managed fund is very good value. Its OCF is only 0.43%. So if you did it yourself, it would probably be a much higher fee. And our fee is less than half the median in our sector.
Okay, so what you're essentially saying is you've got asset allocation and stock picking all wrapped up in one.
Exactly.
Great. Excellent. Let's have a look at where the fund is now. Over the past few years, we've had the shocks of 2022 when both asset classes were really sank in unison. That's fading away into the rearview mirror. And are we now back to the conventional role of such a portfolio where stocks and bonds act as counterweights to each other and sort of balance the volatility out for investors?
Well, Richard, I'm going to give you a slightly caveated answer, which is probably yes. And just let me explain why. So people often think that because bonds and equities have been negatively correlated, in other words, bonds go up when equities go down for most of the last 25 years, then that's the normal state of affairs. But if you go back to the 1970s, 80s, and even part of the 1990s, when I was cutting my teeth as a young Bank of England economist, you'll find they were actually positively correlated for much of that time. And so bonds would fall at the same time as equities. So what's going on? Well, the answer is it's all about inflation. So for most of the last 25 years, inflation hasn't really been an issue. And bonds have reacted to growth rather than inflation, which results in that negative correlation with equities. But when inflation's an issue and bonds are reacted to inflation more than growth, then the correlation flips and bonds become positively correlated with equities. In other words, they're not a good hedge. And that's exactly what we saw in 2022. Now, the key question is what happens from here? Now, we don't think inflation's completely dead, but we do think it's unlikely to dominate the picture as much as it has done in the last few years. So therefore, probably bonds will act as a good counterweight to equities, and certainly will provide more balance to equities than they did in 2022. And they do so with a much more attractive all-in yield than they had before. So our bond fund yields nearly 7%. So for us, bonds are definitely worth having in a balanced fund like the managed fund.
Excellent. Yeah, you mentioned inflation there, and we'll come back to that because, as you say, it's not dead, and there's various pressures on economies around the world that will probably see inflation nearing a floor, if not exactly there yet. But we'll come back to that. So you make a great case for such a portfolio and the counterweights and so on. I think there's a danger that for some investors see it that everything gets cancelled out, making it harder to get real growth. What would you say to people who think that way?
Well, I think the long-term returns in the fund refute this completely. So since inception, we've delivered 8.7% per annum versus 6.8% for the peer group. And overwhelmingly, this has been driven by equities, which are the real driver of growth in the portfolio. the bonds are there to provide the balance in the portfolio, but they can still absolutely provide a good return in their own right. So although everyone maybe focuses on the times when you want the correlation to be negative, times of crisis, a lot of the time, both asset classes are just earning a nice return as they're going on. So you maybe shouldn't overly focus on those times of crisis. But for us, our bonds are actively managed, and they're the best bonds that we can find across government bonds and corporate bonds. So plenty of opportunity to add value there. And we know from the risk analysis in the fund that the presence of bonds has improved our risk-adjusted returns over time. So that's reassuring. And we're also mindful that if we think bonds are going to be less useful in providing balance, then we can asset allocate away from them. So, for example, in 2021, we did view inflation as an emerging risk. And with that very low starting point for yields, we didn't think bonds were as attractive in the portfolio. And so we reduced our bond position significantly through asset allocation. So, I mean, overall, I think that the record speaks for itself over the longer run. If you'd invested £10,000 at inception of the managed fund, you would have £100,000 more than the average in the peer group, which I think really speaks for itself.
Right. You mentioned there dialing down the bonds in times of stress. Right now, broadly speaking, you're about 80% stocks and 20% bonds and cash. Is that generally a default position for the fund?
It's not far from that, but our strategic benchmark is 75% in equities, 20% bonds, and 5% cash. And it's really because we believe equities to be the driver of long-term returns. My colleague Ian is fond of saying that equities offer a return to human ingenuity, which sounds maybe a bit highfalutin, but I think he's actually got to change it, because I think now we have to adapt it to it's a return to AI augmented human ingenuity, because that the world is changing so fast with the advent of AI that I think we have to really maybe rephrase the returns to equities. But then we've got the bonds to provide the balance, the cash to offer diversification and a bit of an option value. When things go down, we can take advantage of that and buy assets when they're cheaper. We can flex those strategic weights plus or minus 10%, but really for the managed fund, the dominant source of returns is the stock and bond selection within the portfolio.
Right. I mean, you say you have this ability to flex the weights. What would, right now, looking at the situation, is there anything that suggests you should be changing the tilt, or you might expect to change the balance over the next year?
So we've got a policy setting group that decides on changes to our asset allocation. And we've got 5 regional equity managers and 2 bond teams that feed in their views of how attractive they see their own portfolios at the moment, and whether they're pushing for more cash to be allocated to them or not. And maybe we're a little bit different to how other managers do it. It's this bottom-up enthusiasm, experienced managers knowing how enthusiastic they are about the assets within their bit of the portfolio, and that's what really drives our asset allocation, that bottom-up enthusiasm. Now, we will discuss the broader macro trends as well, but most of the time it will be that bottom-up enthusiasm that is the driver for our asset allocation decisions. And we're not always positive in equities. Just before the pandemic, for example, we were down at 73% in equities, 16% in bonds, with cash up at 11%, because neither the bond or the equity managers actually felt a lot of enthusiasm for valuations at that time. So where are we at the moment? So our current positioning is that we have 77.5% in equities, which more than our strategic weight. So that reflects our continued enthusiasm for equities. And our bond weighting has notched back up to 20% to reflect the decent level of yields available. So running a little bit lower on cash at the moment. So we're always discussing this. At the moment, equity managers seem very enthusiastic about their portfolios and the opportunities for disruption and the companies that we hold to take market share. So that's where we are at the moment, and I mean no changes foreseen at the moment.
Right. You talked about the equity managers and their enthusiasm. I mean, and the one thing you can say about the holdings in your portfolio is they're very eclectic. You've got giant turnaround companies like Marks and Spencers and Sony on the one hand, and then you've got the tech sector players, giant ones, smaller cutting edge ones. I mean, there's a lot of different types of due diligence to balance there. How do you manage that?
Yeah, well, as a reminder, the equity regions in the managed fund are managed autonomously by the respective regional investment team. So it means that nobody's having to cover all 200 plus stocks alone. Rather, they're covered within teams with in-depth knowledge of their market. So quite often regions present a particular opportunity set. For example, the US is home to most of the big tech disruptors, NVIDIA, Trade Desk, Shopify, etc. Whereas the UK, for example, is arguably a more defensive flavour of growth, Marks and Spencer, as you mentioned. So manager experience of their region goes a long way to ensuring adequate rigour. And secondly, I think our investors at Baillie Gifford are overwhelmingly generalists. So they all have specific areas of interest, but we don't have a tech desk or an energy desk, for example. So our investors are not unduly narrow in their areas of expertise. And because we run relatively concentrated portfolios within each region, obviously for the managed fund as a whole, it becomes a very diversified portfolio, but within each region, relatively concentrated. So we are able to give each holding good cover while not spreading ourselves too thin. And lastly, I would also mention the fact that because all of our investors are based, or almost all of our investors are based in the same floor of our Edinburgh office, and they upload their research to one centralised research library. So very often you'll see our investors leveraging the research of one team or another team, or their experience of investing in similar or competing companies. So I think in sum, we're actually very well set up to deal with looking at different companies in different sectors and assessing their growth prospects.
Right. But I'm just trying to bring out what is the sort of common thread. You've got companies selling air fryers, food retailers, absolutely cutting edge companies in the tech sector. What is the one thing that sort of says that is a great company for this fund?
Yeah, I think what really unites the teams is the focus on finding great growth companies with a longer term investment horizon. So for us, it's not about choosing companies on rich valuations with really speculative investment theses. It is about earnings growth and seeking to understand what the market might be missing in terms of the extent or the longevity of that earnings growth. So all our investors are trained to look for the same thing, which is sustained earnings and sales growth over the long run. We know from academic evidence and from our experience that above average earnings growth is reflected over time in above average share price returns. So it doesn't mean we only look for very rapid growth companies, the likes of NVIDIA, with earnings growing north of 20% perhaps. But in contrast to that, we don't expect Marks and Spencer to blow the lights out, but we do think it can generate solid earnings growth for a long time. And so in a core fund like the managed fund, that's an excellent holding for us to take in our clients' behalf. So the companies may look really quite different in terms of their operations or their pace of growth, but we think a fund like this should have a broad spectrum of growth flavors. But the uniting factor is that all the companies we invest in have the ability to grow in the long run, and that we believe that's not fully appreciated by the market at this point.
Okay. We've seen Baillie Gifford adverts out there talking about future stocks. You've talked about some of the established names there. What role do these future stocks that perhaps haven't come to fruition yet play in the managed portfolio?
Well, Rich, I think one of the points of future stocks is to just really remind people of the types of businesses that we're investing in and why we're so excited about them. And we know that some clients over the last few years, depending when they invested in the fund, have had a bit of a rough ride. So the performance has been challenging over certain periods. And I think it's very important for us to, as we're coming over a good year and performance is top quartile over 3 months and 12 months, but we know from the few years before that people had a tough time. So we think it's really important for us to get on the front foot and just remind people what, the kinds of stocks that we're excited about, the names that they may not know, or some they may be so familiar with. So, I mean, I can give you a couple of examples if we have time to do that. So, The one I particularly like is Sweet Green. So Sweet Green, I was checking this morning, Sweet Green has actually outperformed Nvidia this year, which is no mean feat, I can tell you. And Sweet Green is it's effective. It's a listed US company which is making salads and healthy foods, but to a fast food model, and it's getting quite a following in the US and from certain people that like these things. But so it's an attractive offering. It's healthy for a start, and it's putting people first. But it's the way they're managing the robotics in the kitchen that's particularly attractive to us. They've got a robo kitchen that makes all these salads. So not only is it way faster than humans, I think they could make 500 salads an hour in these robo kitchens, but they don't get this order wrong. So it's not that you order, because these salads come with chicken and steak, and it's not that you order chicken, you get steak. They just don't make mistakes. So there's real attractiveness in the way they operate, and that's allowed it to have really high margins for the sector. And it's got a huge growth runway when you think about the amount of stores that, for example, like the McDonald's has across the US. I think Sweet Green has less stores than McDonald's got even in one state like Texas. So huge runway for growth for Sweet Green, and again, one that maybe not that well appreciated by people.
That sounds very interesting. Let's talk to your specialist subjects, if you like, fixed income. And you've talked a little earlier about we're getting some really attractive yields there. Now, obviously, where there's attractive yields, everybody follows. And you talked recently in a commentary piece about stretched valuations because everyone's piling in, and just the margins are getting too low there between, for example, between high yield and investment grade stocks. Which areas do you see as particularly overvalued?
Yeah, I think actually I would class fixed income broadly as fairly valued now rather than overvalued. It had a recent backup in yields, which has helped that. But we also went through a period of government yields rising really quite dramatically from where they'd been, and then corporate yields having an additional significant spread on top of that, and that was really attractive. So we were overweight corporate bonds for that period, and we saw those additional corporate yields really compress quite a bit. And so we don't think it's fairly valued, but we don't or maybe fully valued, but we don't see any great value in corporates relative to governments at the moment. So we have a strategic balance within our bond portfolio of 50% government bonds, 50% corporate bonds, and we're round about that at the moment because we think both look about right. Still find attractive valuations in the new issue market, in particular within high yield, where we're active bond pickers. So this is really where being discerning and differentiated comes to the fore. So you're not just chasing any extra yield on offer without doing that enhanced due diligence. One example that people might resonate with people is Motel One. So this is the first debt issue from this group, and this is the family-run German hotelier. And over the last 2 decades, the company's grown really fast, from 2,000 rooms in Germany alone to 94,000 hotel rooms right across internationally. And what's been quite impressive is that that's all been entirely self-funded. So there is a bond issue. The management is looking at an IPO in the medium term. So the leverage has gone up a little bit, but the management is guiding that the leverage will come down. The drivers being that free cash flow generation and earnings growth, which is it's a great story. So we think there will be upgrades to the credit rating over time and the potential for yields to come down. So we're still finding examples of exciting things to invest in, but it's probably fair to say that the real, the kind of extreme levels of value that we saw earlier in the year have just dissipated somewhat. I think on the government yields, we had thought the market had got a bit ahead of itself in how many rate cuts were priced in. So that may be contributing to the comments a month or two ago saying that the markets were fully valued. But we've obviously backed up quite a bit in yields since then. And we're pricing in maybe only 3 rate cuts of 25 basis points in the US and the UK, a bit more in Europe. And that feels much more reasonable to us. So, it looks fairly priced. And as that all-in yield of nearly 7%, I think is still pretty attractive. So, we still like them.
Right. Just talking about the government bond yields there, there is a feeling, yes, the interest rate cycle has turned. There's going to be cuts. We don't know how many, but probably not any more official rate rises. On the other hand, you've got these pressures weighing down on governments, defence, extra spending on social projects, ageing populations, the energy transition, and so on. So when you look at government bonds, does this weigh heavily on you that they're going to keep having to borrow more and more as we move forward?
Well, I mean, it's a good point. I think you're right that there are plenty of demands in the public purse, and your starting level for debt is pretty high. So that is something that's topical, and I think in the UK and France, and to a degree the US, markets have been beginning to care about it a bit more. So we saw the reaction to the trust budget in the UK before, but then even with the recent Labour budget, there was a bit of a market reaction to that as well. Not hugely significant, but you can tell the market is beginning to pay more attention. Whereas in the years of very low inflation and QE, people didn't care about the amount of government debt. It didn't feature on bond managers' radar at all. Whereas maybe it's the bond vigilantes beginning to come back again, and I think that's a genuine concern, and we need to just be aware of it. I mean, we'll see. Obviously, the French budget is they're trying to hammer through a French budget at the moment. The market's not liking what it's seeing at the moment. So I think it's when there's the fiscal loosening, but also the political uncertainty. That's what the markets really hate, and that's what you're seeing at the moment, in particular in France. So that's what I think we do have to look at that. It's also true that the easy part of bringing inflation down, that's already happened. And maybe the inflation battle isn't completely over. So we're alive to that, but it's, we need to keep an eye on it. But our central case is, look, growth is, fairly robust, in different regions a little bit, but it's still reasonably robust. We're not about to go into recession or anything. Inflation remains relatively well behaved, at least by comparison with where it's been in the last couple of years. And this outlook allows central banks to continue bringing rates down, and maybe not that much more, but keep bringing them down. And certainly from the managed funds point of view, rates falling is a helpful tailwind for our funds. It's definitely helpful. But our portfolio is operationally very robust to higher rates. So it's not something we're particularly worried about. If rates do have to go up a little bit, we've got much lower debt levels of our holdings than the index, for example. But typically, as rates fall, it's more favourable for valuations of growth companies. To be honest, I think the number one thing is stability, and for the economics not to be on the front page all the time. And now we've got Trump coming into power.
Well, I was going to say, good luck with that.
I'm sure we'll have something else on the front page, and now time to time it might affect economics, but hopefully not too much.
Yeah, because you mentioned uncertainty there and the political dimension in France, and we've got the mother of all uncertainties coming in with Trump. I mean, what happened when you realised that Trump was going to be elected as the next president? Did you all sit down and say we've got to alter the portfolio, or we're just steady as she goes? No,
you'll be surprised how little we focus on it, actually. I mean, that's not to say that parts of his agenda may be relevant, but for us, we are investing with that longer term horizon. And for us, while Trump can change some things around the margin, for us, it's really about the longer term trends and the disruption. So what's happening with EVs, what's happening with battery technology, what's happening with technology within pharmaceuticals. It's all of those things that are, they're not really changed by what Trump does. So, we're not ignoring it, but it hasn't led to any changes in the portfolio or anything. But it's something that people are bearing in mind. And I know we presume that we don't know what we're going to get. It's so unpredictable. We don't know, but we presume we'll get some deregulation. So that and lower taxes if anything. So those things are probably positive for business and the economy. And so it's a probably a good environment for continued disruption, continued growth, and that's the kind of companies that we are really focused on. So it certainly doesn't go against the environment that we would like to see, but I wouldn't overstress the impact that he will have. I mean, a lot of it will be noise, no doubt, but we have to just wait and see what he actually does and see if that does make a difference.
Now we've got one or two questions about this from viewers, and one is, Trump doesn't like ESG, doesn't like, it's drill baby drill, get more oil going. He's very anti-certain health and pharmaceutical things. Does that not sort of blow you off course slightly, at least for the short term?
I don't really think so, because as you said, there's a lot of bluff and bluster, but let's actually see what he actually does on this. And yeah, there's a lot of negative comments about ESG, but you'll find that a lot of the companies are actually just going ahead and doing their own thing anyway, and making sure they're securing green energy and clean energy sources for all their operations. You saw the recent Microsoft news on that front with the nuclear power. And so I think there's a Trump federal angle with some noise, but I think, again, I would just go back to my previous comments. Let's see what he actually does on some of these things. And I think again, we've got such a broad spread of holdings within the managed fund. The US is only 18%-ish of the portfolio, and so we've got lots of other stuff going on in other regions, which again shouldn't be that much affected by Trump. Okay,
I mean, talking about the US, another question we've got from one of the viewers is, you've got Nvidia in there, but it's a fairly small stake in the portfolio, and it's easy to ask this with the benefit of hindsight, but why don't you have a bigger stake in Nvidia?
Yeah, I mean, it's one of those things, because we have these regional portfolios. So the US portfolio is only 18% of the overall fund at the moment, and actually Nvidia is a big holding within that 18%. So the US model, if you like, have had a big holding in Nvidia, but it's we've actually been taking money out of Nvidia recently because we're not entirely sure that the valuation is reflective of some of the risks that Nvidia faces. The chip industry is very cyclical, and people maybe forgotten about that a little bit. And I think on the inferencing side as well, you're seeing companies like Amazon, who've got the ability to take market share, and so you're seeing more competitors come up. So, with hindsight, arguably you might have had more in Nvidia, but we have it within the US portfolio. We've actually had quite a big holding of Nvidia, and it's one of the things that we have to accept, that within the managed fund, it's a really broad church. It's a very diversified portfolio across lots of different regional equity portfolios, and that's one of the things that happens. Right.
I mean, a related question from one of the viewers is, why only 18% in the US? It's 60-70% of world market cap now. The home of innovation, the home of amazing companies. Shouldn't you really be investing more in the States?
Well, then you become a very US dominated fund, and we've really wanted to have that broader diversification across the globe and across opportunities, and we can certainly overweight these regions. So we can be overweight the US relative to other areas. We're not really at the moment, so we're not really reflecting much greater enthusiasm for US stocks than we are for other stocks. Also remember that the stocks that we hold within the US portfolio, there's a lot of disruption, a lot of tech, a lot of early stage companies in that portfolio. So we're getting really good exposure to the best of the US stocks within that. Otherwise, we see plenty of opportunities in other areas.
Okay. So all the questions we've got time for at the moment. Just to sum up, we're going to go back to the title of the webinar, that question that you swerved around when I first said it. Why active? Why growth? Why now?
Yeah, well, I think it was just helpful just to go through some of the arguments first before kind of summing it up. So, we know that statistically the companies that grow their earnings the most have the best share price returns in the long run. There are lots of different types of growth in lots of different sectors, but we're seeing enormous innovation and opportunity. Technology dramatically changes whole industries. So right now is a great time to be a growth investor. Why active? Well, you have to be different from the index to beat it. The index is made up of, it's the companies of the past and the present. We're looking to what will be the companies of the future. So the ones that will benefit from that disruption. So our portfolios can look very different from the index. That's what our clients pay for. And that since inception, we've delivered around about 2% per annum ahead of the peer group. And remember, you're getting that with a fee that's less than half the median. Why now? Growth is attractive. This year, some of the extreme undervaluation has been removed, but the sentiment on many growth companies is still quite negative. Valuations are still very attractive for many businesses which are operationally doing very well. We're overweight equities in our asset allocation. We're not in control of when the market will fully reflect what we believe the valuations to be, but macro stability should help in that regard. So we know it's been a volatile 5 years, and depending when investors invested, it's with us, they may have different experiences. I would just remind them of the excellent long-term record of the fund, the simplicity and consistency of our investment process, and the enthusiasm of the managers for the stocks and bonds in the portfolio.
Brilliant, excellent. That's all we've got time for, I'm afraid. So thank you, Stephen, for your time and insights. And thank you to you all for watching and for your questions. We do have more sessions like this coming up, so please do keep an eye out for those if you found today useful. Until the next time, goodbye and thank you for joining us.